In our previous video, we looked at how borrowing for a home enabled you to bring forward the cost of accommodation in preference to paying as you go, that is, renting. We also demonstrated that it was in both the borrower's and lender's interest for future expected cash flows to be sufficient to comfortably repay any borrowings. Otherwise, good financial health or financial independence would be unachievable. Finally, we showed that purchasing a home, whether outright or with a home loan, significantly changed the composition of projected lifetime investment wealth. Current net investment wealth is immediately reduced by the cost of the home purchase. A home purchase is an increase in lifestyle assets, exactly offset by a decline in net investment wealth. However, this negative impact on projected lifetime investment wealth is at least partially offset by an increase in projected future savings, as home purchase reduces the need to pay future rents. In this video, we're going to examine two other types of borrowing, with a particular focus on how they affect your growth asset allocation ratio. They are 1. Borrowing for an investment that is expected to be able to be repaid from future cash flow, and 2. A speculative borrowing to purchase a home or investment, that is, one that is partially to totally reliant on the value of the home or investment to repay the borrowing. Hi, I'm John Lesky, recently retired personal financial advisor and founder of Fin Health, a tool to guide you to your financial independence. Let's examine the first type of borrowing, that is, borrowing to invest with expected future cash flows expected to be more than sufficient to repay the borrowing. That is, the lender isn't relying on the value of the investment to repay the loan. We'll assume a 45-year-old couple, the Brights, who wish to retire in 20 years. Their current balance sheet before borrowing for investment is shown in the table on the screen now. Their net investment wealth is $1 million, being total investments of $1.5 million less net borrowings of $500,000. Superannuation comprises $1 million of growth assets and $0.3 million of defensive assets. Together with the $200,000 held outside superannuation as shares, total growth assets are $1.2 million. Expected future savings from now to age 65 are $2 million. Added to current net investment wealth of $1 million, this gives a projected lifetime investment wealth estimate of $3 million. Their current growth asset allocation ratio is 40%, calculated as growth assets of $1.2 million divided by projected lifetime investment wealth of $3 million. This compares with a target growth asset allocation ratio to be achieved by 65 of 60%. That is, they need to increase their growth asset allocation ratio over time. The Brights are keen to give themselves the opportunity to accelerate their wealth accumulation. They wish to borrow to invest immediately, rather than wait until expected future savings are realised. Their bank is happy to lend them $1 million for investment purposes, given the expectation that the loan will be able to be repaid from future savings of $2 million and the large amount of equity in their home. So, $1 million is borrowed and invested into a highly diversified 100% growth managed fund. The Brights' after borrowing and investment balance sheet is now shown. Net worth is unchanged. Increased total assets, reflecting the managed fund investment, are exactly offset by increased total liabilities. Now, how does the Brights' borrowing to invest affect their growth asset allocation ratio? The table on the screen now reveals the changes from the pre-borrowing for investment situation. Current net investment wealth, future savings, and projected lifetime investment wealth are all unaffected by borrowing to invest. But growth assets and the growth asset allocation ratio increase significantly. At 73.3%, the growth asset allocation ratio is well above the Brights' target of 60% and their self-assessed attitude to investment risk. This will prove a great result if growth assets prices rise unabated. But the Brights have considerably reduced their future investment flexibility. Of their expected future savings of $2 million, $1.5 million needs to be dedicated to repaying borrowings. Given this and their overweight growth position, they have very limited firepower to take advantage of any future fall in the price of growth assets. Perhaps inadvertently, the Brights have taken more investment risk than they appreciated. Our view is you should never borrow and invest in growth assets to an extent that would take you above your target growth asset allocation ratio. In the Brights case, this puts a current cap on borrowing to invest of $600,000 compared with the $1 million actually borrowed. But at least the Brights don't expect to need the value of the investments to repay their borrowings. This describes the third type of borrowing to be considered, the speculative borrowing, where future savings aren't expected to be sufficient to repay the borrowing. The lender is at least partially reliant on the value of the asset supporting the borrowing to repay the amount outstanding. Let's now assume the Brights only have $1 million of expected future savings instead of the $2 million discussed earlier. Should they now borrow $1 million to invest in a diversified growth managed fund, total outstanding borrowings would again increase to $1.5 million. But this is $500,000 more than expected future savings. Assuming these expected savings are eventually realised and used to repay debt, at age 65, the lender would be reliant on the value of the investments to repay the residual $500,000. Should investment markets have fallen significantly at the time the loan was due, the lender may even need to look to other assets for full repayment. In addition, if the Brights did enter into this speculative borrowing and investing arrangement, their growth asset allocation ratio would immediately jump to 110%. That is, growth assets of $2.2 million divided by projected lifetime investment wealth of $2 million. Their growth assets exceed their total projected lifetime investment wealth. The 110% compares with a target of 60%, their self-assessed attitude to risk. Clearly, any time you're relying on the value of your assets to be able to repay a borrowing, you're in highly risky territory. Unfortunately, this describes the position of many Australians in their 50s and 60s and older, who may have borrowed to buy investment properties many years ago. As they approach their desired retirement age, their future expected savings are often insufficient to come even close to repaying outstanding borrowings. Tax benefits discourage repayment while working, with savings that otherwise would have gone to debt repayment directed to an unsustainable lifestyle. Lenders may become uncomfortable extending those loans beyond retirement, taking the timing of the sale decision largely out of the borrower's hands. If this coincides with a market downturn, many retirements may be severely jeopardised. So, summarising, all the borrowings discussed in this and the previous video allow you to enjoy the benefits of the assets purchase, that is, a home or investments, earlier than if you waited until you're able to finance them with your savings. But they also require you to commit at least part of your future savings to repay them. This may restrict you from pursuing other life opportunities that come along. Borrowing to invest often results in an inadvertent significant increase in investment risk. It's easy to find yourself with more investment risk than you're emotionally comfortable with. This isn't a problem if growth markets perform strongly, but it will cause considerable anxiety should they decline significantly. Also, in the event your future savings are insufficient to repay any outstanding borrowings, you may be forced to sell assets in market conditions that are outside your control to satisfy your lender. This is inconsistent with what we would regard as good financial health. Our view is that you should never borrow for any purpose if the associated transaction, that is, house or investment purchase, would take your growth asset allocation ratio above your target growth asset allocation. And we'd also suggest that your expected future savings should be well in excess of your borrowings, ensuring the lender is highly unlikely to resort to the purchased asset or other security for repayment. Otherwise, you're engaging in speculative borrowing with its potential dire consequences, particularly in soft investment markets. Hopefully, you found this video of interest. I'd like to know what you think. Please provide any comments or questions below. And finally, thanks for watching.